Good evening and welcome to the Australian Stock Market Show. Now, last week the All Ordinaries Index rose by 0.3% as buyers regained momentum, slightly edging out the sellers. So stay tuned as we'll discuss our thoughts on that shortly. We'll also take a look at the world markets, and for our main topic in tonight's show, we get into reliable ASX dividend income stocks that you can buy right now. First up, we'll get into our hot stock tip for the week, so sit back and relax. Again, tonight is jam-packed as we have lots of emails to answer. We'll also take your phone calls and give you the answers to some of the most important questions around the market. Tonight we're excited to share our thoughts on some Australian stocks like Ansell, Sandfire Insurance Australia, Paladin, World Markets and more, so get comfortable as we'll get into those soon. I'm Gillham and I'm your host for tonight, and joining me are two of our team of highly experienced analysts and professional traders, Janine Cox and Philip Tortevsky. And together we're Australia's most trusted stock market educators. Good evening, team.
Good evening. Raring to go and ready to get into it.
Raring to go and ready to get into it. What about you, Phil?
Yep, second that, ready to go. Had a nice pub meal.
Phil's not going to be very good to us tonight after a pub meal anyway. Well, tonight, as mentioned, we get into world markets. But first, let's take a look at this week's hot stock tip. Phil, what have you got for us tonight?
Yeah, so the hot stock tip tonight is Ansell, stock code ANN. So let's get straight into it. On your screen right now is the market index, and you'll see Ansell Limited is involved in the development, manufacturing and sourcing, distribution and sale of gloves and protective personal equipment in the industrial and medical end markets. Very well known for a particular type of equipment they do sell. Gloves, yes, that's the one. And so some metrics on this one. It's got a year-to-date performance of minus 0.91%, a one-year performance of minus 9 versus the sector of minus 2.48, which it's beating. It's trailing, but it is beating the ASX 200 on a one-year basis, which is quite nice. It's got a market cap of 3.5 billion, so quite a nice market cap, and is ranked within the top 200. So is visible for all those institutional and retail traders out there. Now, if we bring up the chart, you'll see the monthly on the left and the weekly on the right. And I want to focus on the monthly for now. You'll see I've got marked up, obviously, a few percentage levels here, and obviously that caught my eye initially on this particular stock because it looks like it has had a really, really nice pullback here, or some will call that a bit of a fall, Janine, but it's fallen about 50-odd%, which it did recently back in March 2015, and obviously we see how the stock ran on and continued all the way up.
It just dives, doesn't it, when it gets going?
Yeah, it does, and I mean, but it's been in a really nice uptrend since September 2021. Look at that, it's gone all the way up. But another thing that really, really caught my attention was this particular price level at $21. Now you'll see Ansell has been hovering around this $21 all the way back from October 2016. It's literally like a magnet for this stock. It's gone there 1, 2, 3, 4, 5, 6, 7 times in the recent history. And the only other time I could find that it did something similar to this was all the way back in April 1987. Now this is just after I was born, so I'm giving away my age, but you'll see that there was another level around $28 back, which it's working in opposite. But the point is that when the stock does like to hover around a particular price point, you'll see that back in September 87, it also touched this level good 6 or 7 times. And then
you've just got a lot to say, haven't you?
I do. I want to get through this because it's a pretty important point, because I mean, we have seen it in the past where it's gone through there, and obviously what's happened is it's fallen away into one of its biggest downtrends ever. So that being said, I think that if the stock can hold here, it's had a really nice month, albeit now it's closing a bit on the low, but it is showing signs that if it can move from here, it's going to be one to watch.
It looks interesting, doesn't it? I mean, it's incredible to think that a stock can hit that level so many times when you've probably got a trend line down there or close to it anyway, and it looks like it's just consolidating nicely above it. But are you concerned about the fact that it's pulled back now to that line?
I mean, look, there is a gap here on the weekly chart, and it's not surprising for a stock to come back and fill those gaps. So not super concerning because it has broken out. It is above this momentum line here. So for now, I mean, we're in that medium-term uptrend. I think it's looking quite nice.
Well, that's a pretty hot stock for me. I like it very well. Well, that is it for our weekly hot stock tip. Now, shortly we'll get into another topic, or our topic for tonight. But before we do, right now is your opportunity to get involved in the show and have your questions answered. It's your turn to call right now on 039290 9988, or you can text the question or your question to the number on your screen. Now, the first caller into the show right now gets a free copy of my book, Accelerate Your Wealth. So make sure you pick up your phone and dial 039290 9988. Now, while you do that, tonight we'll give you our thoughts on world markets. So let's get into it.
On your screen right now is a watch list of the world markets. Okay, so as we can see there, we've got Argentina at the top there, 28.8% up at the moment. That's quite amazing, isn't it? Do you know what's driving that? Has anyone been paying attention to Argentina?
Argentina, no. I know they've got a president there that's doing all the speeches with. He's a friend of Donald Trump.
Yes,
right. He's quite a character.
But have they got rampant inflation?
Inflation, they do, yes.
A lot of rampant inflation over there, so that could be causing it.
And look, next we've got the Nikkei stock average, which is actually up 17.24. We talked about this on a previous show, which is hitting highs and could potentially come back from there. The DAX, 7.6% up for the year at the moment. But it's interesting to see we've got markets mostly in the red dial, except for two at the bottom, the Hang Seng, and we've got the Brazil market down 6.6% still.
Looks like they're mostly in the green, not the red.
I mean the green, sorry. I'm glad you picked me up for that.
Are you colourblind?
No, maybe I am tonight. We're looking at the All Ordinaries Index there in the middle at 2.3% up, which is interesting. The FTSE 3% up. It's another one I like to keep an eye on when I'm watching the Australian market to see how it's going. But the Shanghai Composite Index we'll have a look at now. This is up 1.71%. Now,
for the year, okay.
I thought it would be interesting to have a look at overlaying the US market with the Shanghai Comp, just to see how the two different markets are tracking, which, you know, when you look at it, it's just chalk and cheese. There's no sort of commonality, but it's interesting how the US market's just powered on, and this Asian market is just literally sideways and down for so long. So COVID really had a big impact there, but you know, it looks like it might be starting to find a bottom at this point here, so that's what we're just keeping an eye on at the moment.
So you're thinking Asian markets to be more bullish moving forward and the US market to be less bullish, or what are you talking about?
Look, I still think the US market's going to, once it has a bit of a pullback and then takes off again, I still think there's more legs in that market.
Yep.
But the Asian markets, there's got to be upside there, at least in the short to medium.
So more upside there than the, I mean, the thing is, because, you know, we know with our market over hundreds of years that our market either exceeds the US or goes below it, or then they exceed ours and then comes back below it. But eventually, over a decade, we're pretty much...
Well, any market that they talk doom and gloom about, we just have to watch the charts and keep looking at the trends to determine when the turn is. But eventually they'll turn around, even when the media is still talking it down.
Well, yeah, and so I'm thinking all the research I'm doing, I mean, China has had all those issues with Evergrande and all the other things going on. So you could expect a graph like that, couldn't you? But that's also a sign to start looking.
Exactly.
You know, if you do like to look at markets and emerging markets, and also not just emerging, I mean, China's not an emerging market, but you've got Taiwan, you've got Indonesia, Malaysia, you've got Vietnam, all those emerging markets. And they're going high tech. They're going really, really well. So to me, having an ETF or something in you know, those sorts of markets, getting exposure to those would be great, because to me, if China starts to take off, it'll take those with it, I think.
Sure.
So anything you want to say about the US market before we move on?
Look, I mean, I'd be expecting potentially another month down on the US market at the moment.
Yep.
So you can see on the chart there at the moment, it's only just broken the low of March, so it's April. So we'd expect at least another month down there. It'll then turn around and try to break through that 5,000 points, but You know,
Okay.
it's got some strong support from the prior high here. So, you know, I'd still go with the US market if people are looking at that.
Yeah, I know there's some noise around those Magnificent Seven not being as bullish moving forward. But anyway, that is our thoughts for the world markets. But before we get into the first email, remember to get your questions answered live on air, you will need to text or call into the show. Now you can also send your questions to info@wealthwithin.com.au and we'll answer them in next week's show. Now let's get into our first question. Now our first email is from Matt. It was quite a long email, so we actually narrowed it down a little bit, Matt. Sorry about that. Hi team, a few weeks ago I read in the media about the Japanese government stopping their purchase of ETFs. Now I found this report quite astounding because Dale has mentioned ETFs will cause a financial crisis in the future. Seeking your thoughts on the following one. Governments buying ETFs, should they be allowed to do it? I was aware governments can only buy treasuries and bonds. And 2, if the Japanese government were to sell their mass holdings, would this be an example of the ETF funds not having enough liquidity and cause the effect of too many people running for the exit? Would this be a trigger or a seed being planted for the next financial crisis? Kind regards, Matt.
You're being quoted more and more these days, aren't you?
I know. Well, as Dame Nellie Melba said, doesn't matter what they're saying as long as they're saying it. But yeah, I mean, like, you know, when we talk about markets crashing, people go, they start to overthink the situation. And if we talk about, you know, something like I hate ETFs, I mean, index ETFs is what I talk about. The rest of them I don't have a problem with, but index ETFs I do. So that's the context. But people broadly put ETFs as a big umbrella. You know, and you can't just do that. So what are your thoughts on what he's talking about with Japan buying ETFs?
I mean, just the fact that they've stopped buying them, I don't think is a cause for concern at all.
I don't think it's a concern.
Governments are going to make decisions about where their money is going to flow, and it's going to change. Policy changes. So, but I wouldn't necessarily align it with what you're saying. But I do take my hat off to you, Matt, though, for actually thinking, because that's one of the things I do. I sit there and I think, okay, I've heard this. Now I need to look for some other evidence about what it's all about. But really, you'd probably just say to him, I'll just keep listening to me, wouldn't you?
No, I'd keep listening to Phil, not me. No, but it is. It's like ETFs, it's really, really hard question to answer because just saying ETFs is, where are they buying Japanese ETFs? Are they buying US ETFs? Are they buying European ETFs, Asian ETFs? What are they buying? Are they buying index ETFs, or are they buying ones in specific areas like robotics or AI? What are they doing? And you can't answer the question in terms of that. And yes, traditionally, governments they only get into bonds and treasuries basically, that sort of stuff, because obviously conflict of interest. They can't invest in companies directly, but I honestly have a problem with them buying ETFs because it's a parcel of shares. But again, very hard to answer. And if Japan started selling their ETFs, I don't think it's going to cause a crash. It's just one country. It's more than that. It's much more of a systemic issue. That's what I think in terms of ETFs. Did you want to make any comments?
Oh no, it's just I mean, it's good how people think that you're always trying to connect the dots and say what is that catalyst going to be for the next crash, you know? And like you just said, sometimes looking too far into it is not the best way to do things. It's just, you know, have a look, do your research. That's all great, but always get back to the chart and have a look what's going on, because price will be that leading indicator telling you where there may be the initial signs of markets turning.
Yeah, and I think one thing we need to say now, none of us think the market's crashing now, and it's not going to crash anytime soon, so don't be worried about that. But we will tell you when we think the market's going to crash anyway, but that's a long way away. Now we have an email from Andy who says, hi Dale, Janine and Philip. Wanted to congratulate Optima for their prompt chart update for Paladin following the company's share consolidation. Now, while the 10-for-1 share consolidation was undertaken, Paladin traded on the ASX under the code PDNDA. Now, I spent hours on the weekend updating my analysis on the company and was pleased to find all my price data multiplied by 10 and time and pattern worked all remain accurate. My question is, what is the purpose of a company consolidating shares in this manner, particularly when Paladin was already trading above the dreaded $1 level? Have held this company since July 2023. Sorry, Janine. Thanks for all your great work. Cheers, Andy. Now, just to before I let you answer, Paladin had a 1 for 10 offer, which basically for every 10 Paladin shares. They gave you one, which increased their price tenfold to put it up much, much higher than what it is. So that's actually what happened.
Yep.
I think they're still trading under the stock code, the temporary stock code, aren't they?
I think they've come out of it.
Or they've come out of it.
Yeah, PP.
They normally only sit there for a few days and while everybody works out the data, but as you saw...
I love the part that, Andy, you just said, sorry, Janine. Thank you very much. You know what? I think what's happened with the share price moving up like it does, if I just look at the chart and I think, wow, what a great company. You know, they're no longer the $1 or $2 stock anymore, which I think is the whole purpose of this, which is a great strategy. And, you know, but when I look at it, I still see uranium. So sorry, Andy.
Sorry, Andy. So why did they do the 10 for 1? What was the reasoning behind it?
Well, look, I mean, companies often do this to get boost their shares, because if they're trading at such low figures and there's so many shares on the market, then often they can have lots of little shares as well. So there could be lots of little, amounts of
Small
shares
shareholders.
being small shareholders. So they often do that sort of consolidation. So it changes the mix a bit, but. It's more about, I think for most companies, if they boost the share price like that, just giving the view that it's not a penny dreadful anymore, or it's not a $1
it's a
stock.
serious player,
it's a serious player.
And really the answer is you need to read all the announcements coming out of the company. That's going to tell you exactly why they're doing it. And I read them the other day saying that it was because they want to attract more overseas investors and make it and more bigger institutional type of players. And that's basically what you're saying. If it's now around the levels it's now, it's not a dollar share anymore. It's not a penny dreadful. It's not. It's a serious player on the marketplace. Do you want to say any last words, Phil?
100%. You just nailed it on the head. That's exactly the reason.
Well done for thinking about it anyway. Now we have a text from Florian who is asking us about Kogan. Florian says, it's giving an exit signal this week, but should I use the art of trading to stay with it considering how hard the stock has risen? I bought the stock last November at $5. Thanks, Florian. Ooh. You've got to be careful with this art of trading, don't you? A lot of people go, I just changed my stop loss and that's the art of trading. No, it's not, Florian. You've still got to have rules. Now, you've got the chart up. What do you reckon?
We do, and that's a good point. I mean, the art is a very loose word that...
Some people lose it too loose.
Too loosely, yes. Yeah. And we do have the chart up here of Kogan. We've got it marked in black, obviously, the buy price there, which is quite a nice entry. The stock's gone up quite nicely. It has fallen away in April. I would just say, Florian, if your exit rules have been met, follow your rules, stick to your rules and get out of the trade. I know that you're probably looking at this now and thinking, well, it's not nowhere near my buy price, so perhaps this is just a pullback and I could keep holding for it to go higher. But unless you've done the work and prepared that before the trade is unfolding the way it is, then I'd say close it, do some more analysis, and next time a scenario like this happens, you'll be very well prepared to know what to do.
Yeah, but why don't people take their stop loss when they're in profit or their exit strategy?
Because he's in quite a bit of profit and he's thinking, well, I could potentially get more profit because it is in a nice uptrend. But we're trading with confirmation. That's what we do.
Yeah.
And look, there's nothing wrong with taking the profit and then looking at where can I get back in again. So just sort of making, as part of, making the assessment about getting out, it's about thinking, well, okay, if I get out now, can I still get back in and how would I do that? Just think about the whole picture.
My concern, Florian, is if you decide, all right, I'm going to change my stop loss because of the art of trading, and you don't have solid rules and analysis around those, because the art of trading is really about that, using rules and strategies and getting that confluence and saying, okay, well, for example, the trend line, if the stock's going sideways, it might break your trend line and you go, okay, it's doing this, and every time it does that, it does this, and then it takes off again. So having rules around it. But if you do break your rules and change your stop loss, you'll be inclined to do that again another time and another time, and you'll change it on a stock that's you bought to start falling away and you're in a losing position. This one you're okay because you're in a profitable position, but doing it on a losing position is worse. So that's my sort of caveat on the answer there. Well, anyway, next we've got an email from David who says, hi Dale and Phil. I believe he missed out Janine anyway, but he said thanks, Janine.
Okay.
Thank you for your insightful and entertaining take on the Australian stock market. I watched the video on talkingwealth.com featuring Andrew Einhorn. As recommended, I found this an interesting glimpse into how hedge funds trade. Now, would you mind having a look at Sandfire Resources, which I entered for a medium-term trade recently at $7.90. Previous runs have varied between 30% and 80% gains, and it's now trading near its all-time high. Do you think there's much more to gain or take profits now? Thanks, David. Okay, Phil, what do you reckon?
Yeah, look, very nice entry. We've got the chart up here of Sandfire Resources, and very good that you've done the analysis, David, in terms of analysing how far the stock does run when it goes. And it seems like you've done all the work. All I'll add to your stuff, I'm pretty sure you've doing that kind of work, more than likely you've already got an exit strategy in place here. But for what it's worth, I think that we had this particular period back in June 2016 where it had this similar type breakout. All I'll say is the move back down is also quite sharp with this particular one, so hopefully your exit strategy factors in that when it does fall, it can fall quite sharply. So that's all I'll say on that. I think everything else seems fine.
Janine?
Well, look, he really wants to know, is it time to take some profits?
Correct.
So for me, no is the answer just at the moment, David, because it's still going up essentially. Only because we can see that the close, if we're looking at that weekly chart, is still high on the bar at the moment. There is no exit here. Now, even if the beautiful thing though, David, is that looking at how steep this thing is. So if I just grab a trend line up under there, it's really steep, and sometimes that can be fantastic because you're less likely to lose a lot, off the top when they come back. So you've always got this, when Dale was talking about the art of trading before, you're always looking at what you've got up your sleeve if you're needing to make a decision, the best decision you can make at the time. There's also it's swung down here for a little bit before it swung back up. So it's about that confluence of things that Dale was talking about before. Yes, you're right, it could run out of steam here, and it has run, to the extent of its rise by the look of it potentially before a little pullback. But it could then go rip right through that high as well. You just don't know unless you know why it's actually going up. So, but I'd be protecting that. Absolutely, you're right for asking that question. I'd be looking at, do you use the last low? Trend line, what's the best rule?
But when you want to take profits, it's not just because it's risen.
That's right.
There's something that's telling you
it could fall over.
It could fall over.
And there's nothing there yet.
So just going, should I take profits because it's gone up 10, 20, 30% is never it's the wrong question, isn't it? Really. It's about what's happening on the stock.
How can I protect
what's happening on the chart? How do I protect my profits, and what's the right rules around that? Otherwise you're just guessing, and often when we find people guessing and getting out of positions that are going up, they get out too soon. That's one of the biggest mistakes I see traders make, is they just exit trades too soon.
Without a rule is actually the biggest mistake. So you've got to have a rule. It doesn't matter what rule it is, but you need to have one that you've actually either proven works or you've used it plenty of times before, and you can show that it's protecting your
capital. If they don't have a rule, you're going to get out your boxing gloves and smack a few people around. Is that what you're going to do?
Well, I didn't bring them this week.
Oh, you didn't bring them anyway. Well, that is our take on Sandfire. Now for tonight's topic, we will show you how to identify and select the most reliable dividend income stocks ahead of the next dividend payday. Now our goal is to share how you can make more income on your shares. We'll also share some tools to help you ride out short-term market volatility, which to me is crucial when finding good income stocks, because whilst it's nice to earn income, what's the point if the stock falls away and wipes away your capital? Now, when looking for stocks with reliable dividends, I always ask two important questions. One, are the stocks reliable payers? And two, when is it going to be time to sell? What I find is that most people are fixated on the first question and never really think about when to sell. Big mistake. Especially now, because right now is the most important time in more than a decade to get it right in terms of knowing when to sell. If you haven't had the chance to watch some of the recordings Phil and I have been doing lately, namely our market crash recording, which we did a few weeks ago, and our weekly stock market update, make sure you check them out. Why am I saying this? Well, because the people who do nothing will lose or perform quite poorly. Maybe not in the short term, but definitely before this decade ends. Okay, so let's get back to the first question. What makes a reliable dividend stock? Who are they best suited for, and how do you select them? I'm going to go to you, Janine.
Okay, everybody wants dividends. Well, not everybody, I should say. Short-term traders don't want them. But a reliable dividend is one that you know is going to be there, and it's got to be somewhere around the market average or higher. Okay, and you also want something that's fully franked, ideally, if you can. Some companies, they might not be fully franked, but you just have a look to see whether it's at least 50% franked or fully franked, ideally.
Yep.
The next thing is, who are they suited for? Well, generally it's investors, that people looking for reliable dividends. The investor market want those dividends.
Yes.
And this is where we're going to talk about this in the show further, about the concern is because people sort of get too dependent on those dividends. So we want them reliable. We want to know that they're coming in at the right level, so 4 to say 6%, plus franking, you gross that up and it's a really nice little return there. Banks traditionally are really good at delivering those, but I'm not going to talk about the banks tonight because we always talk about, well, there is one bank. It's not the one you're thinking.
Which bank? That was your joke from last week.
And so we'll come back to the banks in another show to talk about them. But what I wanted to look at was stocks like in service industries where they can pass on the costs.
Yep.
They're important ones, that more reliable revenue streams. They're the companies they want to look for. So you want to look for a history of good earnings, but sort of you might take a balance. So it might be some that you have that history, like some might be banks and some may be service industries, could be even insurance companies, with those paychecks constantly coming in. So we're going to talk about a few examples tonight. Was there anything else that you wanted to know?
No, I was just saying, I was just thinking you're so right. Like, investors look for dividends. I'm sitting there thinking, I can't remember last time I looked at a dividend yield for any share I bought. And I don't really care. If I get them, it's okay. I'm going for growth. I don't care about dividends. And it might seem strange to a lot of people going, I always look at the dividend and I want to get 6, 7, 8%, but I don't look at that. And you're nodding, so you don't either.
But it's horses for courses though, isn't it? So if you've got a super fund, you're going to be looking for good dividends if it's long term.
No, not me. I'm still looking for growth. All right, but before we get into the best stocks, I recently saw some information on CNBC that was very interesting. It started off with Bank of America saying 2024 could be a banner year for dividends and that retirees are about to shift money into equity income, boosting those stocks. Now, I think this is quite an interesting statement. So I want to ask our panel, what do you make of these comments? Janine, are they actually right?
Well, look, I think it's, there are good dividends, but I think that sort of like banner year, if you like, has passed, because the year when they were delivering the big bumper dividends, every company was boosting their dividends to try to get people to hang on to their shares.
Yep.
It's gone. We will still see really good dividends, and we're going to show some of those tonight.
So what you're saying is the news is out, which is always late as normal.
Well, when you get growth, and we're going into a bull phase of the market and we're going into a growth phase, the shares climb, dividend yields fall. You just need the companies to lift the payout ratios, and they may not always do that depending on what their capital intentions are.
Well, it is. You're sitting there looking at me.
Well, yeah, because we're in such an interesting time in the market. Like most world markets are sitting at their all-time highs or are breaking to new all-time highs. And, that's the time for me anyway that you need to start thinking about capital protection, and you start moving to a completely income type strategy, which generally there's no capital protection. It's just get the dividend regardless of what happens to the share price. That's dangerous for me.
Well, thanks, guys. Now you've raised some great points, and to me, it all really comes down to what the reserve banks will do with the interest rates over the coming year. Now, if they do begin to drop rates later this year, then this is when we might see investors start moving into the market, looking for those good income generating stocks. So how about we ask Janine and Phil, everybody, to get into the stocks, and as they go through them, make sure you have your portfolios handy to check if you're already holding any of these stocks that we select. You might also like to let us know if you've got a good one that's not on our list. Just comment below the video on YouTube and let us know your favourite dividend stock. I will hand it over to you, Phil, to bring up the charts. What have you got?
Yeah, sure. All right. So on your screen right now, we've got a watch list. Now, Janine, I know you've been...
Yeah, how about we talk together on this one?
Sure, you've been working on this one.
Yeah, so look, on the left-hand side, we've got the codes.
Yep.
Then we've got the market capitalisation of all the companies that are on this list, and I've just changed that so we can see that there's ALL at the top, some of the biggest ones on this list that came up at the top, and then we've got Franking, so this column here shows you the fully franked dividends, so the grossed up dividends, the franked dividends for the last year, I think it is, and then the average true range. So this is a measure that's looking at volatility, and we talked about this last year. I talked with Pedro last year about this one on our show later in the year. We went through this to look, because this is really about volatility. We talked earlier about looking for a measure of volatility, didn't we?
Well, yeah, we said we wanted income stocks, but income stocks that are reliable. And reliable stocks to me mean stocks that aren't volatile, that you're going to get that really non-violent price action whilst collecting the income, you know, as
and like the sort of stocks that ring to mind, you know, some of the big stocks, like we said, which stock? Well, CBA is a pretty good example of that, but at times it can actually fall away quite heavily. But when I went through the list, I was looking for some of the service companies. I'll just pick an example of one that was on the list that we ended up picking, if I can see it. I think it was AGL, so I'll just change this so we can quickly see that. Now, this actually does have big swings in price, but it's a good service company that could deliver, and this is where you've got to sort of balance it out. You're not going to have all of your dividend stocks that are just plodders. You might have, you know, a handful of banks, but then a handful of stocks that could turn out to be good growth stocks, but can be reliable.
We did find some though. We found some good ones, didn't we? That are reliable. So let's maybe get one of them. So
let's just have a look. But what I wanted to show is one more thing. So on here, we're looking for anything below 6%. Okay, so something, a measure of volatility below 6%. And we're looking for dividends franked up that are above the market average or around 5 to 6% ideally. So the first one I picked was Macquarie. Like, this is a really good example. You get a great dividend from a stock like Macquarie, but see, at the moment it's just trundled on, it's trapped in this sideways move, a good opportunity to get some good dividends, but there'll be a really good opportunity to get into this one at a lower risk point in time and still get some dividends. So there's one for you. But some people don't want to pay $200 for a stock, do they?
Yeah, it's funny when you look to the right-hand side and you see the number. I know we've spoken about this, and we've even said, you know, we look at this like it's just a number. It's like a number on the back of a jersey, really. You're going to be paying...
Who cares if it's 10 cents or 10,000?
So look, just have a look at the weekly chart then. We can see that really nice little pullback sort of... It's wiped out most of the gains that we've just seen, but you know, just got to mark the line in the sand. If we get a horizontal line, we can see much of the resistance came from that prior high there. We're just waiting for that to move back through. Then I think if it starts to push up, it'll challenge that high and keep going up. We'll see some further gains on Macquarie. But if we see a really strong pullback and it takes out $170 on the downside, then I would be just sitting back and waiting.
Forget the income.
Forget it for a little while.
If the market's moving, this is likely to go with it all, isn't it?
It has to,
do really, really well.
Historically, it's always been one of the best performers.
Yeah,
that's right.
I love it. What's the next stock, Phil?
So next we've got CPU Computer Share. Now, this stock has been obviously one of the stellar performers on our market, you know, since coming in. And why I say stellar is because, you know, this stock continuously breaks through to new all-time highs, albeit there is that typical movement in price that you see, the up and down, the ebbs and flows. And that's the thing, with the reliability that we're talking about, you're going to get those ebbs and flows. There isn't going to be any chart on you know, on the ASX that's going to give you a complete straight line price growth with and you know, the income to come along with it.
Unless the straight line's down.
Yeah, well, yes, exactly. But it is giving you a somewhat reliable type of movement with regards to price. And I mean, look, recently, this last month, April, it's shot out really, really strongly. Again, perhaps, what are we here? The previous all-time high was 28.34. Taking it out. So again, proving the point, it continuously makes new all-time highs.
When a lot of other stocks are falling away. So.
Of course, yeah. So, you know, if you look at April, the market was down over 1% just today alone, and this thing's continuously going up.
It was pretty strong last week. They've shot up.
So another good one. And now IAG. Now, some people might think, oh gosh, why would I want to have IAG? Now, at one stage, Warren Buffett came in and bought up the shares and then dumped them, and then
everybody thought it was going to go through the roof because Buffett bought it.
Yeah, exactly.
Like, yeah, good on you.
Because nobody hears about Buffett, you know, swimming in our waters, right? Anyway, look, I mean, this has reached a really interesting level. So I'm not suggesting anyone look at this right now, but I was just fascinated by seeing this, and I looked at it. I thought, okay, volatility, even though it's had some swings down, it does really get going nicely. So and it trends really well. So pays a reasonable dividend. I thought, well, you know, if it can get through this level and we can get some upside, we've got to the all-time high here, because of course we're looking for reliable dividends, but we want to see that growth as well, which Dale was talking about before. So there's 33% to that upside, which I'm liking.
Yeah, but I mean, if I'm gonna put my income hat only completely here, I mean, if I move this horizontal line, that there is, a bit of a historical, if you will, median price here for this one at around 540, so it's not far away from typically what is the historical median price. So, if you are that complete income type investor and you don't care too much about the growth either way, then you're not at a bad spot in terms of where it is right now. You're pretty close to the median. So, I mean, this one probably gives the best opportunity
So what you're
right
saying
now.
is that sort of swings around a bit, but it could actually, if it comes back to there, it's probably not going to get much lower, is what you're saying.
I mean, it can swing up and down in between that level, but you're generally close to it right now. So it is, a bit of an opportunity, I guess.
Do you want to use the mouse?
I'll use am I using my hands again?
We like it when you use
We really need something where the fingers work on the... But look, in terms
I'll
of
get you one of those laser pointers.
Yeah, please.
Yeah, it won't work.
we used to do that with the... anyway, I'm not going to go there. But in terms of the actual share price, it is rising quite nicely, since June 2022. This is in a long-term uptrend, albeit part of a longer-term downtrend, but it is in a nice uptrend and, really nice at the moment.
Super fun, long-term, medium-term.
Yep.
Yeah, you're okay with all that?
Yeah, I'm okay with that.
Cool.
All right,
What's the next one?
ALQ is the next one. Now, this is one out of the box a little bit. I thought you might question me on this one. So it is a more volatile stock, but believe it or not, with the measures that I was using, it came up fine. And it may be just because it's measuring more, the last year, which has been a sideways action. But it recovered really quick in COVID, which I thought was a good sign. So that was another measure that I was using. Plus, I'm looking here, we've got this high here in 2012. We've got the recent high in November 2021. If this thing breaks through that and it's paying a good dividend, I'd be pretty happy with that one. It looks like Commonwealth Bank, which is interesting, isn't it?
And it looks like a lot of the stocks on the market. In fact, it looks like the index.
And it's quite a diverse company in terms of the services that it provides. So, as long as it stays above this low here, this February low, I'd be pretty happy with that one.
Okay. That was short and sweet.
Yeah.
Yep, we've got plenty. I actually put extra stocks in, so I know I said 5, but you know me.
Yeah, no, you can't count.
I wasn't thinking that.
I can't spell and you can't count. No.
All right. So, look, next we've got Washington H. Sol Pattinson, which this was one of my hot stock tips a little while back.
It was actually,
I know, that's why I picked it.
Yeah, and I mean, look, another one of those stocks, since inception, you'd be loving this. It's just continuously gone up and up and up, breaking through all-time highs, and recently did that during September 2021. Obviously had that nice little healthy pullback, and again it's resuming back to its normal state, these higher highs and higher lows, and paying obviously a nice income as well. This one I really, really like. So from a growth perspective, you can get the growth as well, which is very nice. And it is that, we say sometimes certain stocks like Telstra does it a little bit, although now it's not the case, but they get that nice slow plodding type up movement, which is the perfect combination when you want income and you get that nice little plotter slowly up.
It's perfect for a super fund. It's perfect for a longer term sort of blue chip portfolio. They get your plotter, get a reasonable dividend, and that's really what you're talking about here.
I'd like to see it come back a little bit, actually. I think it's going to be great, Phil. I'd just like to see it take out this low here in January 2024, then settle down, and then off it goes again. Because like you said, there's decent upside in here to that high, and then once it gets through, it's in blue sky.
And even just as you've drawn that, that's 13% to the high. And even if this one does start to move around, being a little bit more volatile, I mean, really, you probably need to sit in 20% is probably as much as it would go, judging by the nature of these bars, these individual bars. If it's got 4 or 5 bars, let's just say.
That's
like
a worst case scenario.
Yeah, what I'm saying is, and you're sitting only with the 20% perhaps drawdown, which is quite acceptable. I mean, people can handle that. You're not going to be sitting here with the potential for this to fall 70, 80% out of nowhere and think, oh, geez, what do I do now?
Yeah, and that's one of the critical things. If you've got somebody who has a super fund or a long-term
and
portfolio,
they pick really volatile stocks.
They're generally really risk-adverse people, and then you see some of these portfolios. They're like this. Some of the stocks they've got and go, why have you got that? It gives you a heart attack all the time. Whereas something like this, like a CSL or a Cochlear, some of those other really, really good stocks, banks, so much better, aren't they?
Aren't they?
So what's
All
the
right.
next stock we got?
Now, in here I've got, did I do AGL already or not? I just mentioned it.
You
That's right
mentioned
in
it,
the
you
watch
didn't
list, but I
actually cover
haven't.
the chart.
Yeah, I just didn't show you the chart yet. So looking at the medium-term projection, I really like how it's actually, it trends for a little while and it comes back. But, like Phil said, in its whole movement, when we're talking about the last stock, it could move 20-30% as it falls away, but then all of a sudden you get this nice rise out of it again. If it takes out this low here, I just forget about it. This is the low in February 2024. But again, more service sort of industry, potential to increase costs, but then we've seen the industry really being, tight, screwed down, if you like. But I don't think that's going to last forever. So I just keep an eye on AGL for...
Look, it looks brilliant to me. I mean, I'm sure it's just humming along, isn't it?
Humming along, yeah. Obviously coming out of that, big move down, but doing nice things since November 2021.
Well, over the last year, the volatility's dropped off a lot compared to what it was in the past. So that's what I'm really looking for.
Yes.
And so when we look at Amcor, this is an example. It is falling away at the moment, or has been falling away.
Jeez,
and
that was quick on AGL.
It could actually still go lower. I'm trying to sneak a couple of extra ones in there.
God,
So again,
I was about to say
cheeky.
something on AGL and you were on to Amcor.
Oh, do you want to go back to it?
Well, I was just going to say,
can.
with energy prices are tipped to continue to rise, because
Yes.
the more we push renewables, the more energy is going to go up. So the point is something like an AGL able to profit from that, of those price rises? Because obviously oil, gas, etc. Is that going to help their bottom line? And if it is, then are they going to be able to pay good
Well,
dividends?
oil's
on
going
it?
up. It's
Yeah,
not going
well,
to
oil is going up, but it's about, obviously,
How do they-
they're supplying it, obviously, to the net. So if they can keep their costs under control and they make more profits, that could be much better for their dividend yield.
Exactly,
Now
I
you can
agree.
go to Amcor if you like.
Yes, please. Now, look, Amcor, probably over the last few years, it would probably have made a reasonable dividend stock, given that it's just sideways. There hasn't been a huge amount of risk to the downside, except for this last pullback here. And even in the pullback that we saw in COVID, it recovered and went up really nicely. If it takes out this low here, I would just let it fall and just wait for a better opportunity. Just get a trend line in on it. And also thinking about the dividends. Don't just think that trend lines are for trading. Trend lines are for helping you find dividend stocks at the right time as well. So, and reducing your risk. So if this takes off above that line, it could be a really nice one.
Yeah,
Cool.
said it perfect.
Okay, we can move on, can we? But I do like your what you've picked, all those stocks you've picked. So I'm sure we've got some more in the second half of the show after we go to our break. But anyway, that is it for our topic for tonight. Now stay with us, as we still got plenty of emails and stocks to go through. We are also going to reveal something very interesting that all traders must be aware of. Now this is something you don't want to miss. But before we do, for those watching on YouTube and Facebook, you can watch all of tonight's show, plus our additional bonus or exclusive content from tonight's show on talkingwealth.com. So head over now and grab your free 7-day trial. On talkingwealth.com, you can watch our Australian stock market show that we do every single Monday, where we share our views on the market, plus some great buying opportunities. And every week, we also share multiple stock tips that will pay for your yearly subscription for Talking Wealth. Now, if that's not enough, you'll get hundreds of amazing interviews with global industry experts in the stock market, finance, gold, money management, mindset, well-being, fintech, AI, business, and loads more. This is all on talkingwealth.com. Now, moving on, if you want to talk about a stock or ask a question, pick up your phone right now and give us a call on 03 9290 9988. That's 03 9290 9988. Or you can text the number on your screen. Now, whilst we wait for your call, let's get into our next email. Now, this email is from somebody without a name. G'day Dale and Janine and Phil. I'm taking a fancy to coal stocks at the moment due to coal coming off a decent low. Can you please take a look at Whitehaven Coal? I aim to buy this for the medium to longer term if the trend allows. If you look at the monthly, it has had a retracement of under 50%, which gives me a price target of $15.78. Looking at an entry in a combination of high and at $8.43. Thanks, guys. Hooroo. Whoever hooroo is.
Well, yeah.
But at least he signs off nicely. Hooroo. I think he's an Aussie.
Yeah, whoever you are, Huru, I like your style.
White
Picked a
Haven
good
Coal.
stock. This potentially was going to be my hot stock tip for the week. So
Well, there you go.
he's got a really nice taste here. And look, Whitehaven obviously has had this nice fall or correction, if you will, from the October 22 high, giving that consolidation type pattern, which we've seen time and time again of recent with a lot of stocks on our market, Janine. And I like the entry above $8.40, obviously clearing all this price action here. You would think if it breaks into these blue skies here, it's going to continue on up. The only thing I would say now, it does have the potential. I'm not totally against the target of 1578. It is, to me, more of a longish, longer term type
Well, he's
target.
looking medium to long term.
Yeah, so medium to long term, it is a potential level. But I mean, even if we just marry up this particular move, obviously that's about 700 odd %. Now, if it were to repeat something like this, then maybe we'd get there. And this stock does have the potential to, when it does move, you can see it moves quick and sharp. So I like the fact that it's the way it's setting up right now, and if it can break through 843, I think you're onto something, Mr. No Name.
There you go. Janine, you got anything to add?
Did you say no name?
Mr. No Name.
Mr.
Mr.
No Name.
Huru.
Huru?
Oh, Huru, sorry.
Mr. Huru.
Huru. Is that the
Well,
name? Oh.
You have nothing to say. Okay, cool. That's I've never seen Janine speechless yet. Now we have a text from David who is asking about Ramsay Healthcare. David says, I entered on the March breakout and I'm keen to hear your thoughts. Cheers, David. So Ramsay Healthcare. Phil's just bringing it up right now. What have we got, Phil?
Up it is, yep. Ramsay Healthcare it is on your screen right now. And did David mention that he was looking to purchase this stock? Is that? I've got it.
No. He entered on the March breakout.
He entered on the March breakout. Okay, so
Yes.
the March breakout was somewhere around here. If I zoom my mouse pointer in.
We were looking at this actually, and just because of the nature of the fall that we saw, we just thought it's a little bit too early. It had a nice rise and it was all smoke and mirrors, as you can see, that big push up here in March 2024, and it's just been sold off strongly. But often stocks will come back into these types of consolidations, which is what it's doing now. It may slow down, but I'd really want to see it get above around at least $55 and pushing up strongly through that level. Otherwise, it could just continue to fall, because this is what gives you the really bird's eye view on what's more likely to happen. At the moment, it's found support off the COVID low, but how strong really is that? Is the strength in this really higher up that's sort of more here, and it's really just gone down below that point? There's still a risk right now that it could trade lower. That's all.
Does that really look a bullish move, that pattern, to you?
No, and if, just looking at it here, you can see that obviously it's had this big fall in August 2023, and just simple mathematics, it's taken 1, 2, 3, almost 8 months for the stock to try and take out what it's done in 1 month on the way down, and it hasn't been able to. Obviously, in April now, it's started to fall back away. So to me, it looks like it's really struggled to get higher from this level. But I see what Janine's saying also in the fact that sometimes when stocks do move into these significant lows, they can move a little erratic in terms of price action. They can bounce up and down and break highs and lows. So if it were to hold at this level, as you said, Janine, $51 and rise up, then potentially in the short term, this could be one for further price rises.
All right, there you go, David. Now we have a text from Hamish who says, hi guys, I'm a short-term trader and have a question for Phil. What are your thoughts on the theory behind entering a trade where most people would put their stop losses? Thanks, Hamish. Interesting.
Good question.
I think Janine's the best person to answer this.
You're to the conspiracies, aren't you, Jenny? I mean, it speaks a little bit to that, doesn't it?
Well, you'd go short, but I don't think I'd go long.
Well, he's basically saying buying where most people would have even a long stop, under a recent trough or, something like that. Now, I would say backtest everything. Backtest everything, but just remember that the retail trader makes up, I know in FX, less than 5% of the market. In stocks, it's, 30% or less.
That.
So, just think about how much money is getting poured in on one way and how much money they're collecting.
Well, that's a really good point, actually, is to look at the volume that comes in at the point when it actually takes out those levels. So, where a stock is being exited, and then having a look at what's actually happening with the volume.
I used to think that way when I was a lot a lot younger earlier in the game. But even working on
just after 1987.
After 1987, but even working on the in the institutional side of things with the fund, we had services where they would be able to aggregate a price for you for the day. Now that involves using algorithms to move price up and down. So it's not that stops are being taken out specifically to take you that's got a $2,000 position in the market. It's it's just that they're accumulating a position at that level, and where you've placed your entry could be that case. Now, the fact that you are a short-term trader as well means that I'm sure you're looking at charts less than weekly charts, daily charts if not less, and your stops are super tight as well. So the fact that you are on the shorter term time frame or a short-term trader means that you are susceptible to having markets take out, because you're looking at a previous trough, let's just say on a 10-minute, 15-hourly chart where, that particular trough to the left of the screen, you're probably in a down move that...
Well, what about all the shorters are coming in at that point and you're trying to buy when people are going to be shorting it?
I mean, it's much harder. It's like we always say, when you read a book, when you're looking at monthly, weekly charts, you're looking at the whole story. When you're trading super short term, you're basically reading one page in the middle of the book. So you're stuck in the woods, and there's so many peaks troughs to deal with.
It's much more fickle. That's what
it's very common. Yeah, it's very common.
All right, next we have an email from Philip who writes, "Hi Dale and Philip, thank you for your great stock market report presented on Monday night. Monday and Tuesday nights are both great shows with you two and Janine on Tuesday night. Now my question relates to currency pairs, and I am hoping you could provide some insight. I'm travelling with my good wife to Europe in August 2024. I've looked at two charts, the AUD Euro and the AUD Swiss franc. Both charts have similar trends, that is the Australian dollar is losing purchasing power against them, although there has been a slight sideways move edging higher just recently. My question for Dale and Philip is, should I buy my foreign currency Euro and Swiss franc now, or wait closer to the departure in August? I'm hoping you have some time cycles that will assist. Kind regards, Philip." I don't know, maybe we'll let Janine answer it first.
Sure.
I think you're the man for this one.
Okay, sure.
She's not playing much, and then she's passing the buck.
Great name, by the way. And look on your screen, we've got the Aussie dollar euro chart, and you'll see that, look, in terms of the euro, it is trading at the historical mean around that 60 odd cent mark. So I know, if you look at this chart, obviously it was up at the 84 cents, and you're not getting value that you would have got even back up to 70 cents in recent time, June 2022. But, albeit all things considered, it is around 60 cents, which is a historical mean. So, I mean, you're getting pretty much fair price here over the history of this one.
Well, he's going in August. Yeah. Now halfway through April, so it's like 4 months. How much is it going to move?
I'd probably look at the seasonality on this as well. Is there some sort of seasonality on the currency that to see whether it is impacted by that?
We could. I mean, if you really wanted to. But I mean, it's just
very cyclical.
It's tracking sideways right now, and it's been tracking sideways on a monthly chart since March 2023 for the best part of a year. So I don't think that it's, by the time he goes, there's going to be too much volatility.
That's what I'm thinking.
So I would potentially get it right now. The only thing that could happen, because it is tracking sideways, there is a potential that it could break out to the downside, which could be worse off. It could break out to the upside, but it also could break out to the downside.
So why not hedge the position, hedge the bets, and sort of take some now and some later?
Well, you could, but it's you're going on a holiday, so most of your expenses are paid before you even get on the plane. So it's just spending money. So you got to look at it. Are you splitting hairs? It's a few $100. So
is that all you spend when you go away?
Currencies don't move that much in 4 months. Sorry?
You said all you spend a few $100s when you go away?
No, that's all my wife lets me spend, not how much we spend. She spends it all, and I spend a little bit. So she comes home with a big suitcase full. Yeah, anyway. But to me, it's about little splitting hairs. It's not worth it doing too much. And anyway, our next email is from Kieran, who writes, "Hello team. I have a question about margin loans, but before I give the question, here's a little bit of context behind it. I've completed the CFD course and traded CFDs over the years. However, given the higher risk, I placed higher control measures in place, and I found myself that my small leverage portfolio in CFDs would have got similar results with far less stress. and work if I would have just put it in my long-term portfolio, letting the big stocks do the work for me. So given my love of long-term trading, I would like to enhance this with margin lending. However, with most loans at around 10%, it seems too high to get any benefit from margin. From my quick math, unless a portfolio returns a higher rate than the loan rate, it would be detrimental. Just wondering what your thoughts are on this. Regards, Kieran. Now, Janine, I need you to talk now.
Well, I have got something to say. I remember when you and we ran this workshop and we were showing everybody an example of margin lending.
Yep.
And back in those days, you didn't have to pay up front for the margin loan. So now the margin lenders want you to actually pay for money that you're not even putting into the market.
What do you mean pay, like prepay your interest?
So you've actually got to pay a percentage. So with margin loans, you're paying on at least 20% of the value of that.
So they want you to draw 20%.
They want you to draw 20% and start paying them interest on that, regardless of whether you're actually putting it in the market.
So it's not prepaying your interest?
No, not prepaying.
Because I know you do that pre-30 June to get a tax deduction.
Yeah, but prior to the GFC, you didn't have to do that. So that's really interesting in one measure.
Yep.
So you're actually paying something and you're not investing. That's a mistake. But if someone's just going to, we've got lots of stocks to buy, then I suppose that's, not an issue. But if you're trading actively, then it can be, you're paying money for nothing.
Yeah, but I traded with margin loan for gazillion years before the GFC.
I know, but in those days, you weren't actually paying for it when you weren't using it.
No, but my interest rates were 7, 8 odd percent, sometimes 9%. I went,
yeah,
because
you're getting
an average 4% dividend, so straight away you'll halve your interest rate at least.
Well, we showed that example, and I can remember we looked at National Australia Bank as one example, and that's one of the stocks that's gone sideways. And even still, with the dividend and having done a margin loan, you did quite well out of it.
Yeah, and to me it's also your interest rate is tax deductible. So when you take in, you're getting dividends and a tax deduction on your interest rate. It turns out you're paying 2-3% for your margin loan, and if you're getting 20% growth out of stocks, that's pretty good.
I actually think the question is, when do you use a margin loan and when don't you?
Correct. So the time for using a margin loan is coming. But then it'll also be coming that it's time not to use it.
Stop using it,
So to give you an example, from 2003, low in March 2003 to the high in 2007, the time to use it was after 2003 right up to probably early 2007. Let me talk about January, February, and then forget about it, pay it down and get rid of it. That's the time to do it. So when the market's really hot is the time we turn the tap down, was what we see and what we showed, or Phil showed in that report that we did for on talkingwealth.com, when we talked about, we did a whole hour report on stock market crashes when we thought it was only 10 days ago, whatever it was. We showed this report that shows the retail investors get in at the end and they get out at the troughs.
Yep.
But we also have a chart that we haven't shown anybody yet, but we probably will, that the margin lending and borrowing really peaks at the top of it before a crash, and the getting out of margin lending peaks at the bottom.
We've actually shown that before.
Have we shown it on this show?
Not on this. We may have actually shown it on this show as well, because we did research on this years ago.
Anyway,
and it's basically a bell curve. So the massive increase in run to the GFC and then a massive decline afterwards of the margin lending.
So to me, there's two things. I don't have a problem, Kieran, with taking a margin loan and buying good stocks for the medium to long term, but I suspect your CFD strategy was wrong, because to me the CFD strategy should be making easily making you really good returns with a small amount of money. So if you've got a $5,000 CFD account, you should easily be getting the returns of your bigger, longer term portfolio if you have the right strategy. But
that's interesting as well, isn't it? Because if he's concerned about the money that he's paying, one on the CFD, and two, the margin lending interest, if the CFD one's set up really into a sort of a lower risk type strategy, it could pay for his interest on the margin loan.
Absolutely, could absolutely do that. Now we have a text from Sarah who says, "Hi guys, I love the show as well as all the interviews. Now I bought Woolworths at $36.10 as my first share purchase. Well done. Now I did not create any rules for selling. I'm learning about them now. Do you think Woolworths will come back? Keen to hear your analysis. Thanks, Sarah." Well, thanks, Sarah, for sending in your text, and thanks for the comments. Woolworths, can you help Sarah out?
Yeah, sure, Sarah, and congrats on purchasing your first stock.
I think it's exciting, your first one.
Oh yeah, it's a great time. And now look, we've got Woolworths on your screen. It has fallen away from that $36, and now it's coming into actually a level here of around $32, which has been potential support in the past back in November 22 and also September 2020. So you're at a critical level here now, Sarah, that the stock could potentially start to reverse from. But that being said, we need to start to see some signs of that happening. And if we just go zoom into price action a little closer on the weekly chart, you'll see that we are not seeing any of that just as yet. But the fact that this particular week, this week in April, it's come back and tested this low. If it can hold above and not close through this low, then perhaps you're getting the very, very early sign of a potential change. But
So
we do want to see.
if because she's in it, now obviously your first trade, you're going to be nervous, and if it falls away and you're in a loss position, the emotions are going to be there. If it keeps falling away, what do you think she should be doing?
I think she should sell. If it keeps falling away below $32, I think she should sell. Take it as a nice lesson. Learn from.
Keep your losses short.
Keep your losses short. Learn from the experience. Keep your profits.
Let your profits run.
And cut your losses short.
There you go, Sarah. So follow what Phil just said. So, but congratulations on buying your first stock. So well done for that. Now remember to show your support for our channel and smash that like button. Now if you enjoy watching and want to see loads more of our content, click subscribe now. Now subscribing helps others find our channel so we can help them too. Now before we let you go, what was your favourite part of the show? Was it our hot stock tip or Phil's hot stock tip? Our topic for the night, or was it a viewer question? Let us know by commenting below this video. Now thanks to those who are watching on YouTube and Facebook. If you're watching on talkingwealth.com, stay tuned for more exciting bonus content, stock picks, insights and strategies. We'll be right back with all that and more. Next week in our main topic, we get into the top 10 most consistent ASX growth stocks. Make sure you join us next Tuesday night at 7 p.m. Australian Eastern Time. Now if you love our show, remember to hit that like button right now and subscribe to our channel, as this shows your support for the team that puts in the effort each and every week into bringing it to you. If you are subscribed, then you'll always know when we go live and put up new content. As always, thank you for joining us. For now, goodbye, good luck and good trading.